This was the craziest stat I saw. So in Toronto in May, only 42 new condos were sold, which is absurd. The 10-year average is 2,000. You're listening to the Ottawa Real Estate Podcast, your go-to source for all things Canadian real estate. And now, here are your hosts, Paul Stevenson and David Warren. Hello and welcome back to the Ottawa Real Estate Podcast. My name is Paul Stevenson. I'm joined, as always, by David Warren. We are both level 2 mortgage agents. David is also the owner at Referral Mortgages here in Ottawa. And we're here to bring you the latest and greatest in Canadian real estate news, information, updates on the market, the whole nine. Want to take a quick second to thank our sponsors, Gertin Poirier Avocat Lawyers, Centum, and Big Insurance in Westboro. I usually switch it up there. David, how you doing? How was your Canada Day? What's going on? What's cracking?
I'm good. Canada Day was great. It was good weekends. Got up to the cottage. It was. But Canada Day itself was slow around. Stayed in town here, a little slower, nice and relaxed. Spent the day basically at a park, which was great. Currently, as you can tell from my backdrop, I'll do a little plug here. The new home decor store above Santini Gallery, store my wife and I own, Santini Gallery Art Gallery in Ottawa on Preston Street, and we had just opened a home decor store above it. So I'm recording from here this morning while my computer is in the shop.
Yeah, love that. Yeah, the story actually is great. I know when during Italian Fest, that was kind of the first weekend it was open, and it was a pretty steady stream of humans heading upstairs to check out the goods. Actually, it looks like a similar backdrop to the one at your office because you have that same kind of like cover. So it looks like you just threw up the sign as like a promotion. You know, you're actually in your office right now. Yeah, no, Canada Day was the same for us. We actually were up at the cottage with you on the Monday night, and then Tuesday we came back to CP and just kind of took it easy. Saw the fireworks here from our back porch. There was a whole bunch of live music here in town, so we went and checked that out. But most importantly, Dave, the market seems to continue, at least in Ottawa. Now, we got stats from kind of across the country today, but in Ottawa specifically, the numbers seem consistent. I know for myself, and I know we've had this conversation off air, like still very busy, still a lot of people putting offers in, a lot of movement in the market as far as transactions happening. So generally speaking, like what has June, July looked like for you? Because I think in June we had a lot of guests and we weren't really talking necessarily specifically about the market. So what have you been seeing, I guess, the last, let's say 6 weeks in the summer?
So, I mean, a lot of my clients the last, couple of months, like you said, 6 to 8 weeks. So pretty steady activity of purchases, or purchase agreements coming in from all different price points, not so much condos, more so freehold, a couple of condos, but more so freehold, which I think is indicative of where the market's at. A lot of people, looking at the single family homes and not the condos, so to speak. But a huge portion of clients really just up for renewal within the next 4 to 6 months. And so wanting to set that game plan ahead of time, wanting to consolidate debt, refinance, or just as they're up for renewal on maturity date, it's always a good time doing that. We've obviously talked ad nauseum about that. But yeah, it's kind of been I would say, at least for myself, in the 65% on the refinance renewal side of things. Refinance more so like as they're coming up for renewal. And that other 35-40% in the purchase area. And again, all price points from, those lower priced homes outside the Ottawa market, like in the Valley, to kind of larger price points, in the million plus within Ottawa. But again, it all just depends on the area.
Yeah, I'd say I started the year very heavy on the renewal refi. And now I would say a lot of renewals happening, like kind of August, September, October, November, like kind of end of the year, and now starting to have those conversations. So it's starting to pick up again. But the last 6 to 8 weeks, even 2-3 months has been probably 70-30 like purchases to refis or renewals. But the beginning of the year was very renewal heavy. And I think that's just because a lot of people kind of buy in that, October, November, and then they close kind of January, February. I know we had a lot of closings. I think 3-4 years ago, January is like the busiest closing month for whatever reason. So there's a lot of renewals that came up there. And then kind of end of the year, I'm now starting to see a lot of August, September, October renewals coming in, but a lot of purchases still happening. And that's kind of why I wanted to bring it up, because I think the sentiment by a lot of, in my opinion, I know it's not statistically a buyer's market, but every buyer I talk to, no urgency, Like they're taking their time, they're looking at homes, they're being very selective, which I think is it's a good thing. That's a good market to have. But if you're a seller and you're expecting a price from 2-3 years ago, I think that we're now starting to see a lot of, and I think when Greg was on last, he was talking about like people taking the property off and then reposting it, a week later at a new price point. And that's kind of skewing the numbers a bit as far as like new listings and days on market and things like that. So the days on market may not be fully reflective of what we're seeing. However, I still believe that the houses that aren't moving is because they're priced too high, because there's a lot of buyers. I have a lot of people pre-approved right now shopping that are just waiting. Like they're just waiting. They're not going to overpay. They're all trying to get, I don't want to say a deal, but almost no one is paying full asking price unless there's another offer that's already on the table. And I would say people are usually going in, 5 to 8% below asking, and they're kind of meeting around that like 96 to 98% of the list price is kind of what they're agreeing on. That's what I'm seeing.
Yeah. And I mean, kind of speaking to that, before we get into the other markets and national figures, we might as well just kind of look at what the Ottawa board was seeing for June. So Ottawa housing market continued to display remarkable strength through June. Statistics from the Ottawa Real Estate Board for June show that the number of sales surpassed last June by 11% overall. So there's an increase in sales activity by almost 11%, 10.6% to be exact. And with the average overall price of a home in Ottawa rising by 5%. Again, this is June 2025 to June 2024. So an increase by 5% to 727,152. The single family home segment showed great strength with a 16% increase in the number of sales and a 5.4% increase in average sale price to 877 from a year earlier. In contrast, the condo segment, so this is where I was kind of leading into this of the activity that I've personally been seeing of kind of that slower or not as many purchase agreements in the condo area. These numbers kind of speak to that. In contrast, the condo segment showed some weakness in June with the number of sales down 21% from the previous June and the average sale price down 6% to 418,886. So the average sale price of 723 is obviously is that average between the single family home at 871 and the condo at 418, and what the activity is like. Active listings are up 11.6% to 4,350. And the months of inventory are showing, at least from this, at 2.7 months of inventory, which is interesting because we were up to 3.8, I believe, 2 months ago. So we are obviously seeing, a slowdown in listing activity. Obviously, the June number I just mentioned of being up 11% year over year is not kind of speaking to that, but obviously there is whether that be properties just coming off the market and not being sold, people deciding to hold them as a rental. Maybe they were up for renewal. We talked a while ago about a lot of properties being vacant because, maybe tenants moved out or new inventory, a new build that they were listing and not able to sell. So I think some of that inventory number was consolidated or brought down likely by those properties coming off the market and held instead of actively listed or held off until the market picked up. But I mean, really from those June numbers, it was a pretty active June in comparison to last June. So we'll kind of see. I know, we saw kind of that push from the typical spring market. June is not that typical spring. It was really quieter. So I'm curious to see, we talked about it before, it'll be interesting to see if that spring market was just delayed and rolls into June, July, August, which July and August is usually a little bit slower, especially August while kids are out of school. People take family vacations and things like that, or spend time at the cottages or whatever it may be. But it'll be curious to see if that was just pushed. And now with rates stabilizing, people up for renewal, kind of that more time, kids out of school, and maybe they're people taking time off work, that whether that activity continues or whether we get that regular lull that we're used to.
Yeah. And if you're a buyer, like if you're shopping actively right now and listening to this, like I think now and August are the months to be super aggressive. Like if you see a property that you love, I can assure you that the sellers are probably not getting a lot of showings currently because of exactly what you just mentioned, Dave. We were out for brunch last weekend with a pair of friends of ours. Their property is listed currently, and it's been up for, I think it was 3 to 4 weeks, and they've only had one showing. And it's not, I mean, it's a beautiful home, like meticulously kept, but just no one kind of shopping in that market, which is surprising. It's a beautiful street, it's a beautiful home, and just not much activity. So if you're a buyer and you see something you like unless there's already multiple offers on the property when you go to see it, the likelihood is that, you can probably get it for a good price right now until the market, in our opinion, like kind of picks up again in that September, October, when then everyone's kind of rushing in to get everything done before you know the winter is coming, right? So that's something to keep in mind too. Something funny I actually saw yesterday, it's a bit off topic, but I thought it was relevant. If you're looking at homes, I saw a realtor partner of mine post about ring cameras and how most clients and realtors now are actually using that for negotiating power, in the sense that, like, when people leave the home and they're like, oh, I loved it, and they're like talking in the driveway, that they can pick up on that, and they're actually using that to their advantage in the negotiation. So kind of
That's
funny. So
funny.
yeah, so just make sure your lips are tightly sealed until you get in your car and have that conversation. Um,
The I think it's funny you talking about kind of that delay for any buyers. Now, like, looking now might be a good opportunity. Something that we see every year, and it is really the same timelines that people have is, the spring market is people buying because they want to move in the summer while kids are out of school and before the new school year starts. So typically that's why spring is busy. So that people can be in the home over the summer, get their kid registered in a new school, especially if it's a new district or anything like that. It's not disrupting school year. Then there's a lull in July and August because kids are out of school and people taking family vacations. But then as soon as they go back to school in September, if they haven't found the place in spring, they take July, August off from looking. They say, heck, we're already in school, whatever. But then they start looking in the fall, in that, September, October, beginning of November timeframe, because they want to be into a home by Christmas, to then, if they have to change districts, they're able to do so for that beginning of January. And so it always repeats itself every year. And that's why we're saying right now it's the expectation of a lull, but we did get that spring market push. So it's these cyclical timelines that people, that as home buyers or sellers, to be cognizant of, like how you're pricing your home, whether that's to be aggressive because you need to sell it. And when it's typically a slower time, like it is now in the market, price it super aggressively if you're having to sell, especially if you already bought another house or you're needing to unload it. And if you're a home buyer, again, now, while it's kind of a lull in activity, it can typically get you a better purchase price or better opportunity on that buying. So kind of keeping those typical cyclical markets or timelines throughout the year in mind as you're shopping and or listing, and how you price, how aggressive you are is something to certainly watch and keep in mind. This isn't just us anecdotally. This is like,
mm.
you really see it in the fluctuations of activity throughout the years.
Yeah, do it for the kids. That's basically what we're saying here.
Well, it's basically
Um,
for the headache. Do it for minimizing the headache
yeah, sure.
of the kids. Yeah.
So a change in pace here. CMHC, they had their spring 2025 residential mortgage industry report come out, which is kind of covers the data for the end of 2024 and some of Q1 of 2025. So a bit dated now. Obviously, we're July, so the Q2 numbers will come out. But I thought it was worthwhile kind of going over how we started the year. The other thing I wanted to mention that you were talking about last June. It's important to keep in mind too that last June rates were still in that like 5.25, 5.5 type range, right? So it's been a very interesting shift. Like, now we're talking low fours. Like, rates have come down literally 1 to 1.5% for fixed rates. So you would assume that the market would have maybe picked up, and it did kind of beginning of this year. But now, everyone's kind of accepted now that those are the rates, and nobody sees it as like a favorable rate. But if you go back to, February, March of 2024, it's where a good fixed rate was 5.69. So rates have come down a lot, and I think that kind of plays into these numbers from CMHC. So the first category was mortgage debt and delinquencies. So it says total residential mortgage debt reached approximately 2.3 trillion as of February of 2025, which was a rise of 4.5% year over year. National delinquency rate climbed from 0.17 in Q4 of 2023 to 0.21 in Q4 of 2024. I think we covered that when it happened. And then CMHC notes that delinquencies are rising from low levels, particularly due to job losses. And this all kind of plays into the provincial stats that we have a bit lower down here. So The next category is a shift from variable to shorter term mortgages. So variable rate mortgages surged to 42% of new origination in early 2025, mirroring a collapse in the variable rate premium. Fixed rates, terms 3 to 5, which is kind of the standard, also remain strong. I would say more people are kind of shifting back to 5 years now. 5 and 3 are kind of on par right now, rate wise. But there was a section kind of February to April where the 3 year was 10 to 15 basis points lower than the 5 year. So a lot of people were kind of feeding into that 3 year kind of surge. But now I would say, and I don't know if you would agree, Dave, but most of my clients, if they're taking fixed, are kind of leaning towards that 5 year just because, who knows where rates are going to be in 3 years. And if they're equal, you might as well take the extra 2 years of that lower rate, right? Not knowing, you're kind of rolling the dice if you take a 3 year, because rates could be up, they could be down. So, maybe it's a good choice, maybe it's not, but the safer choice for me at least is the 5 year, and that's kind of where people are leaning. But definitely more conversations about variable right now, and the Bank of Canada's held their rate twice now, right? So the expectation is that we may see a drop again, but I mean, the market seems fairly resilient, at least in Ottawa. I can't speak nationally. But all that to say, like, the economy seems to have somewhat balance, even though we're still waiting for a new budget to be tabled, which is obviously very likely to create a larger deficit. So what that means for the overall economy is yet to be seen. But right now, I mean, the expectation is that we're still going to see one to maybe two rate cuts this year from the Bank of Canada, but nothing yet. So the variable rate conversations have slowed a bit, at least on my side. Do you still have, just while we're on this topic, Dave, are you still seeing a lot of people kind of asking about variable rates, or like, what are you seeing in your conversations with your
I'd
clients?
say predominantly variable still
Really? Okay,
in
interesting.
conversation.
Yeah.
Just with variable and fixed, whether it be 3 or 5 year fixed, being pretty close at par with
Yeah.
the variable. And that expectation of still further drops, not just this year, but even going forward, and the unknown with the US and tariffs, which if tariffs continue, that might push us further into a recession. It's kind of been this looming term of recession has been it's been looming for a while, and nobody wants to actually admit that we are in one, and that's we're kind of hovering around it, in and out of one. But depending on how things from a negotiations with the US go, and it seems to every week be on and then off and on and off, as far as like so how that negotiation pans out will, from a macroeconomic, at least Canadian wise, and then also the geopolitical overseas, there's so much uncertainty. So which, when we have a lot of uncertainty, again, we fall into recession. The only lever that the Bank of Canada has, one of the only levers, or the biggest one, is that bank prime, and and dropping the overnight lending rate in order to stimulate the economy. So a lot of, at least the people that I speak to, and I speak to, a lot of not as many first-time home buyers. First-time home buyers are certainly more in that fixed rate, get it locked in, not have to worry about it, like that. A lot of resale and investor clients that are, more sophisticated or apt to following the economic market are, we're talking about variable, just kind of with it being at par, expecting that drop, and then the ability to convert it to a fixed, having that flexibility for minimizing payment, all that good stuff. So yeah, that's kind of where most of my conversations have been. But there is, it becomes tricky when you're looking at it, like you said, kind of that fixed rates have stabilized and that they are substantially lower. I was talking to somebody yesterday. They have a property right now. They're going to convert their primary residence into a rental, and they've got an accepted offer on another place. Their current rate on their current home is 5.84. They close on it July of 2023, and their fixed rate on it is 5.84. And so when they looked at it of what the rates would be now, let's say on a 3 year conventional being, around the 4.24 or whatever it is, they're like, wow, that is a significant discount to what we were at. Like, and they're kind of like, well, maybe we should just lock that in. And so they're, kind of coming in behind, but they opted for variable as well because of things being at parity. So a lot of it comes down to individual preferences as well, of like whether somebody is used to purchasing a home, whether they're used to budgeting, whether they can handle any fluctuation in payments, things like that.
So yeah, and that's a good point, because I think the majority of my clients are either like newer buyers or people renewing, and most of those people, especially coming from like a 189, 224 type fixed rate environment, they really like, it's already a bit of a sticker shock to the new rates. And that's kind of the conversation. Like, if we go down, like you're kind of at par, if you go down 0.5%, that's great, but there's no guarantees of that. And also, like, because of an adjustable rate where their payment would actually fluctuate, they just don't want to think about it for the next 5 years as to, okay, well, if rates go up, am I get like my payment change? Like they just kind of want to set it and forget it, which is really just a client specific, right? Borrower behavior and affordability. So just going back to the CMHC report. So it says many new borrowers, and I'll kind of pump through this because I want to get to all the regional stats as well. Many new borrowers capitalized on lower rates to reduce monthly payments, but did not shorten amortization periods. So, there was that extension that allowed people to take 30 years. I would honestly say that I'm seeing a lot of people opting to at least look at what the 30-year looks like. People are very aware of it now. It's very well advertised, and a lot of clients are asking about that 30-year, at least first-time buyers. Elevated household debt ratios persist. So the debt to income ratio declined, seems contradictory here, modestly from 175 to 169%, but remains the highest among G7 countries. So that means, generally speaking, like the overall debt that people have compared to their income is 169%. So
you owe $169 for every dollar you earn is what that
yes.
is
Yeah.
effectively saying. We're down slightly, but still highest in the G7, which is no bueno.
Yeah. Economic risk. So with over 2 million mortgages due for renewal over 2025 and 2026, many borrowers will face significantly higher payments compared to pandemic era rates. Also, we have these conversations all the time, so I can kind of speak for you on this as well, Dave, but it's important to understand, like, when you're up for renewal, you are kind of a free agent. So that allows us to look at every lender possible. Like, you're not bound by the lender you're currently with. So we have the opportunity, if you're with, the blue lender or the red lender or whoever bank, we can look at all the lenders we have and figure out like what makes the most sense for you, whether it be just transferring dollar for dollar or kind of extending that out to make the payments manageable. So if the payment is unmanageable, if it goes up, 30, 40%, there are options available to you that can kind of bring it back to the payment you were already paying. Now that comes at a cost of longer amortization, likely higher interest paid and so on. But it really depends. Like, if you can't afford it, then that's the lesser of two evils, as opposed to having to sell your home and so on. So just all this to say, like, if you're thinking renewals, think David and Paul. No. But when you're thinking renewals, like, just remember that there are options available, and like you're not bound by the same lender you're with. We can look at like the full range of available options as far as mortgages go. Report itself flags microeconomic risk, so especially weaker job markets and interest rate volatility. Rates have been fairly stable for 3-4 months, but I think that's kind of the calm before the storm. Like, I think there's a lot of things kind of in flux. Parliament is kind of in, they're kind of out. They're not really, like, everything is kind of paused right now, it feels like. So I think we're going to see more shifts in rates at Q3, Q4 of 2025. So that'll be interesting to see what happens.
Your home is one of your biggest investments, and the team at Big Westboro can help you protect it. Our expert brokers will find the perfect coverage to keep your home and belongings safe. Call 613-239-5792 or visit thebig.ca/Westboro for a free quote. Think big. Protect what matters most. Are you trying to grow your mortgage business? Centum has the tools and support to help you take your business to the next level. Get access to everything from free unlimited custom marketing to daily direct pay. Find out what your business can do with Centum. Learn more at joincentum.ca. Are you thinking of buying or selling a residential property? Relationships are at the heart of every real estate transaction. At Geltin Poirier Avocats Lawyers, we love to bring residential buyers, sellers, agents, lenders, mortgage brokers, and the law together to close the deal for you. For an effortless client experience that opens doors, call us at 613-744-4488 or visit our website at geltinpoirierlaw.ca. Let's get to the heart of your deal.
So changing gears here, do you want to talk about those GTA stats, Dave? Because they were pretty staggering, like some of those numbers.
Yeah, so GTA, this is based on June 2025. We've talked about it, I'm sure, like briefly, and I'm sure a lot of people have read it as well. Big markets, and we'll get into like mostly Toronto and Vancouver, that they change a lot of the dynamics of the national figures because of how populated they are and what their price points are at. But GTA sales slipped 2.4% year over year, which I don't think who thought that would be even possible. With 6,243 properties sold, though up 8.1% from May, signaling a potential market stabilization. Don't know about that, but City of Toronto saw sales rose 3.5% year over year, reaching 2,319 units. The rest of the GTA sales dropped 5.6%. Distribution of sales across different property types. Townhomes decreased by 4%, detached homes 2.9%, condos 2.5%, and semi-detached by 0.7%. Price and listings. So average sale price was down 5.4% from June 2024, and then the average benchmark also fell 5.5%. So the average at that is at 1.1 million still. New listings totaled almost 20,000, so higher by 7.7% compared to last year. And active listings surged 31,600, a 30% increase, almost 31% increase from the previous June's 24,000. So a huge surge in listings over last year, active listings, and properties just sitting on the fence. So market context and outlook, buyer hesitancy tied to economic uncertainty, notably a trade war with the US and shipping markets. Toronto Real Estate Board commented that improved choice and lower borrowing costs are aiding buyer activity. And future factors may support market recovery. A trade deal resolution, additional interest rates cuts could increase that confidence. I think the Toronto market, just like the Vancouver market, this is my own opinion, are going to be going through hell for the next few years. The problem right now in Toronto and Vancouver, and watching some of the experts in those areas the past few days, is really that not only do you have this inventory sitting, typically it's been investors, for rentals buying a property, or foreign buyers, things like that. And so with immigration basically at a standstill, schools not taking on as many, especially in the GTA and GVA, taking on, people are just, hesitant to buy. They're not purchasing, period, end of story. And so, what's really happening is, as this inventory sits, the developers are also watching this. We kind of talked about it last week as well when we were talking about the developments, is that developers are also watching this inventory level of the resale market. And if that inventory isn't being bought up, a developer's not going to start a new condo development. Yeah, right. That's going to take years for that inventory to come online. But in order for them to get construction financing, they have to pre-sell anywhere from 50 to 70% of those units. Now, if investors, foreign buyers, or domestic buyers aren't buying those units pre-construction because there's so much resale activity on the market, developers aren't able to start that build. And they're not willing to even start that build, to even self-fund that development, because they don't want to be sitting with inventory in the tens of millions or hundreds of millions of dollars worth of inventory that they're now floating on their own dime over an unknown period of time. And so I think it's going to steamroll over the next few years, that this inventory will eventually get bought up in these areas, but then there won't be any new inventory coming on the market. So as it's absorbed, it's going to be, I think they will have a rebound, but it'll take a while for prices to rebound a bit. I mean, it's a good thing in the Toronto and Vancouver area of prices coming down and stabilizing, because it is bringing down rents. We talked, in the past episodes, we talked about rents coming down across the country in a lot of these markets as well, which is great for renters. They're coming down for buyers, that price coming down. There's obviously the other side to it, that there are people losing money on the other side, but with that stabilization. But I think it's going to be seen more so in the next few years of issues that will arise. So we'll see. Did you want to touch on Vancouver as well?
Yeah, I do. But I just want to kind of to make it more like, because I find when people think of construction and new builds, like it's almost like it's hard to fathom or understand the economic side of it. And I think just from like a microcosm explanation, like picture, like just from that inventory standpoint, imagine you have like a lemonade stand outside your house and you're selling lemonade at, $1 a cup, which is, I actually saw recently, which is crazy, the inflation on lemonade. But if you still have, 50% of your jug left, you're not going to go make 2 more jugs of lemonade, right? Like you're going to have to sell what you have to even think about starting again, like you said, because it's basically a waste at that point. So we're kind of stuck in that position where like nobody really wants to buy at those prices. Builders don't want to take on the risk of building more homes without any guarantee that they're going to sell. And we're kind of in this stagnation right now, which is, I think, going to, as you said, have a ripple effect across the country. Steve Suretsky, who's a self-proclaimed real estate aficionado, but he's a Vancouver realtor, investor, and the host of the Looney Hour. We're actually hoping to have him on a bit later this year. He sends out kind of like a Soretsky report by email that kind of summarizes, stats and headlines across the country. So this is kind of the summary of that most recent report. So this is from July, so just a few days ago. So for housing starts and sales, June resale homes in Vancouver, so kind of touching on all the main cities here, were the second lowest in 20 years. And the condo market is flooded with record listings, signaling widespread investor pullback. Prices are falling as supply far exceeds demand. So what we were just saying, and developers can't justify launching new projects. So kind of exactly what we just summarized. Developers like West Group cite a cost of delivery crisis. And we touched on this about a month ago, but housing can't be built cheaply enough, yet buyers won't pay the high prices required. So like it doesn't make economic sense for them to basically even buy the materials to potentially start the build in the future. This was the craziest stat I saw. So in Toronto in May, only 42 new condos were sold, which is absurd. Like the 10-year average is 2,000 and only 42 new condos were sold in May. That is like mind blowing because I mean,
and it says it's like market paralysis.
A 5 million person population, 42 new condos were sold. Like that's crazy. Yeah, and like you said, it really is a market paralysis. Nobody knows what's going to happen, so everyone's kind of in this like analysis paralysis. It reminds me of one of our friends.
Well, but what we're talking about in Toronto just a minute ago of like those developers of new product, 42 new condos sold in an entire month in a population, like you said, of 5 million plus for that entire area. That's outrageous. Like, why as a developer would you even start your project? Why would you even like consider starting that project? And it's going to lead to a lot of developers going underwater and bankruptcy. That will shrink that market as well of who's available to even build. And they're sitting on these such expensive parcels of land, so many construction jobs. But anyways, I'll let you continue. It's just it is a wild stat, like 42 like new construction condos sold. It's wild. Yeah.
So it says if this continues, up to 40,000 construction jobs in the GTA could vanish, which was warned the Altus Group. So we did talk about that as well. I think it was 30,000 last time, so we've actually increased it by 33%. Both Vancouver and BC government are deferring development fees to try and keep projects alive, which is also, we've been talking about that for a while. The development fees and fees to kind of start your own projects are astronomical. So that is kind of a red tape. Now it's not the ultimate, but it is like it factors into it. And I found this very interesting. Developers are actually lobbying the federal government to end or soften the foreign buyer ban, arguing that presale model depends heavily on foreign capital. That's very interesting because I think there's, it's a very politically toxic conversation, but that ban that they currently have on for foreign buyers expires in 2027. So people are kind of debating, like, are they just going to let it quietly expire in 2027 and just let foreign buyers kind of flood back to the market? Or are these, developers, are their lobbying efforts actually going to be successful and have the federal government change that rule so that they can allow foreign buyers back into that condo market? What do you think, Dave? Like, do you think it would be a good idea? And what are kind of the potential implications of allowing those foreign buyers back in?
I think it's got to be looked at, and I'm not the expert to look at it, but you've got multiple different angles to look at. I mean, yes, we could look at, in this sentence, it's talking about developers looking at it for the pre-sale. So they're looking for their own bottom line. They're lobbying for that, but that's not helping Canadians domestically, like our citizens and the affordability here. So that pre-sale model, depending heavily on foreign capital, is really just to keep up the developers and basically unloading those properties so they're not holding them, which they are private entities. And there's obviously only so much they can hold, which then, like we talk about, can snowball, that if they're holding them too long, then they can, basically start defaulting on their loans and they go bankrupt, and then there's less developers. So there's less product down the line many years. But without the foreign capital and with this foreign buyer ban, we've seen prices coming down, rents coming down in a lot of these major markets. So there's that argument as well of, if you bring back all that foreign capital, that's just driving up resale prices and new construction prices. So I think there's many different angles in which to look at it. I think at the end of the day, it's, the boom of immigration we had for such a period of time where we increased our population so dramatically in such a short period of time with no way to handle it. I think, having that ban in place plus then putting the absolute brakes on immigration is, what's hurting these markets. But I don't know that lifting that foreign buyer ban is necessarily a good idea. And there's, like I said, there's so many different factors that play into it. But I can see why developers would be lobbying.
Yeah.
Obviously it's in their best interest, but is it in the best interest of all Canadians? I don't know. Something that CMHC is looking at and risks that they have is that CMHC is now backing 90% of rental construction loans, which, for those that don't know, CMHC is a crown corporation. Anything they're backing, which like we talked about earlier, yes, mortgage defaults are up, but it's still not even close to a percent. It's up to 0.21%. But CMHC is now backing 90% of rental construction loans. So they're saying it exposes taxpayers to growing risks as rents fall and immigration slows. So as whether those projects can sustain themselves. But lately there was CMHC on the rental side of things. So CMHC is the only kind of game in town from a multifamily or rental financing standpoint. So once you build a purpose-built rental, whether that be 5 units, 6 units, 100 units, whatever that building is, what is considered a multifamily property, which is 5 units and up, you can go conventional, which is leveraging the bank's money, or you can go insured, CMHC insured. They're raising the premiums on their MLI Select program, which came out a couple of years ago, and the way in which a lot of people are building. Problem is that they're making these changes effective July 14th without really much notice to anyone. And if you did not, or you do not have your refinance or your application into CMHC prior to July 14th, you're subject to the increase in rate premiums, which doesn't sound like it might not be much, but they're actually doubling the premiums in most cases, anywhere from 106% and up to those premiums. Now, what does that do? It increases the cost of carrying that mortgage. It increases the taxes charged on that premium, which obviously falls on that builder, developer, whatever it may be, which then all cycles back to them needing to charge more in rents in order to carry that property. And so how does that affect the market in that regard? So those of you that are maybe developers or that are small builders or interested in it, please reach out to me. There's a great article that I have on the MLI Select program and how its impacts will affect the premiums and what their changes are going to be. But unfortunately, CMHC is, and they did this about 9 months ago as well, of changing their metrics on that MLI Select program, which is one in which most loans for rental buildings, I believe it's about 80%, of loans for those rental buildings are going through that program. It impacts them dramatically. And they just change things on the fly, even if a project's under construction and being built under what their parameters are. They change the goalposts for a lot of people mid-construction, which throws things out of whack as well.
Crazy. Yeah.
Eating up additional capital, again, raising costs, which then raise costs to the market for tenants, et cetera.
Yeah, we had a real world case yesterday. Like, we were with a colleague yesterday midday and we were chatting about this, and they said that they knew someone that had, originally it was I think a $90,000 premium, and it jumped up to $220,000, like after they'd kind of, put all their numbers together and so on. So now potentially the project doesn't make sense either as a builder, right? So it does definitely skew the numbers across the board, and it has that ripple effect that we kind of mentioned earlier as well. David, lots of info today. I think we should slide into some mood boosts. What do you think?
I think so.
I want to give a quick shout out, because I think she'll probably be listening. A quick shout out to Shelly and Sydney. You know who you are. That's all. Okay, I got four for you today. I got four. Number one, what do you call a fish wearing a bow tie? Sophisticated. Sophisticated, yeah. Number two, where do you take someone who's been injured in a peekaboo accident? The ICU. The ICU. Number three, my wife told me I had to stop acting like a flamingo, so I had to put my foot down. And last but not least, this is my personal favorite. I told my coffee it was grounded, and now it just sits there, bitter. Oh, I like the witty ones, I like the ones where you're like, what? Oh, that half second of like, what? I got it. Thank you as always to our amazing sponsors, Gertain Poirier, Avocat Lawyers, Big Insurance in Westboro, And last but not least, Centum. And thank you all for listening. We really appreciate your support. Check us out on our socials. We have exclusive content on there, great shorts, videos, whatever. We're there. We're present. David, have a great week. We'll see y'all this time next week. Shows are released every Wednesday, 10 a.m.
Deuces.
See you later.